Okay, so welcome everybody. I'm going to just kind of jump into our agenda. So it's as per usual, we're going to take a little look at the market, talk about the treasuries and yields and what we expect to happen through the next 12 months or so. We'll take a look at the economy, the Fed, alternate investments, and then kind of a brief takeaway for what we expect through the end of the year and moving into next year. So let's just dive right in. So S&P 500 is up about 0.5% from last time. I do think the momentum is starting to slow on the growth here, and we're probably going to see it, if it hasn't already, have it peak and start coming down, certainly by January 20th, which is Inauguration Day. That seems to be a trigger, if not sooner. So S&P, as we've been doing, we've been slowly pulling our gains off the table as we see this market go up and shifting it to be a little bit more conservative. So I suspect we'll continue to do that over the next month or two. Okay, so one of the things, and I apologize for the cloudiness of this slide, but it was one of those where I saw it and I just had to take a picture of it real quick. One of the things that really gives me pause about this market is this chart, and we've talked about the smart money, and smart money is the insiders, the executives at companies, the hedge fund managers. And right now, executives are selling their own stocks at an all-time high. And so that's what those red bars are showing on this chart. So you'll see, while we're at the peak of the market, at the end of the year, we have executives selling their own stock. I believe if they had an optimistic view of where they thought things were going next year, they would likely hold that stock. And one of the things that's been talked about is the tax structure being changed and potentially reduced under a new Trump administration. So the fact that people are selling their stocks at the end of the year before those potential lowered tax rates are introduced is even more evident to me that the market, they believe the market's going to come down. And the benefit of waiting for tax rates to change is less than just paying the higher taxes and not suffering a loss on the market. So along those lines, the smart money, last I checked, about 75% of the selling in the stock market was the smart money, and about 75% of the buying in the market was the retail investor. So we don't want to be those people. We don't want to be the ones helping them sell their stock. So this is another example of why I think the market's coming down. So this chart goes back to 1929, and the big blue section is kind of the standard deviation of where the market should be. It should fall between those lines. And you'll see just in the last month or so, we hit the outside line of that. So if you do charts at all, or you look at statistics at all, things are way out of whack. And so I believe we're likely to see that come back again here in the next 2 months, we're going to see it start trending back down, I believe. So that's the S&P 500 and what we're looking at. As far as the Shiller PE ratio, I'll give a kind of a brief explanation, but PE ratio simply is the amount of years of current earnings it takes to equal the value of a stock. So you'll see last month was at 38.25. That means 38 and a quarter years it would take for the entire stock market for the earnings to equal the value. Historically, that number's between around 16 and 20. Average is 16. This month, we ticked up to 38.55, which is the second highest point in history. So you'll see 2000, we got up into the 40s, up around 43. I don't think we're going to get up there this time, but every time it's exceeded 25, it's dropped 50% or more. That does not mean it's going to happen this time, but I believe there's a fairly strong likelihood that we see a 50% pullback on the market over the next 12 months. So 20-year treasuries, they peaked, the yield peaked, which means the value came down. And since the yield has come down, which means the value has gone up. So we've seen treasuries, the long-term treasuries go up in value over the last month. I think we're going to continue to see that trend. Interesting, the Fed has now cut rates in 2 straight meetings, likely to do it in a 3rd straight meeting. And despite that, the Treasury yields have stayed about the same over that period of time. So their cuts are not affecting the Treasury yields so far. Next is the long-term tips. Kind of the same trend. We saw it spike up in our last meeting, up at 2.1%, and so it's since come down, which means the value of those tips has gone up over that period of time. Those are a couple of the good things that we're going to see. You're going to see most likely the value of the long-term bonds, both treasuries and tips, go up. Okay. In the economy, we've been talking about this a little bit. You'll see we're seeing delinquencies on mortgages back up at levels where they were in 2009, 10. So no change in the feedometer. I think certainly they will cut in their next meeting. They may slow it depending on what Trump does in his first 100 days. But we'll wait and see what happens there. Where we saw bonds rebound, we also saw gold rebound over this last month. It was at $26.22 an ounce. As of this morning, it was at over $2,700 an ounce. So it's continuing to rise. As I've said in the past, I do expect gold to dip when the market dips, but then at some point become divergent, and gold will continue to rise while the stock market goes down. So there may be some short-term opportunities to invest in gold and silver at prices lower than they are now, and potentially see them go up despite the market going down in the future. Which brings us to silver, same kind of story, higher than it was a month ago, and starting to build some volume back in there. So I expect we'll see some new highs there, with again a potential dip when the market starts coming down. So the big takeaways for this meeting are, again, we're starting to see a rebound in the bonds. We expect the Fed to continue to make cuts. We expect the market to hit a peak sometime over the next 2 months, and that we will begin to come down. Now, here's the good news. The way we've been investing, less than 25% of your account is tied to the stock market. You get to start finding stocks at incredibly low prices and benefit from buying them low, getting increased dividends, and funding those dividends over time. So those are our takeaways, and that's it for our recording.